Hi, everyone. Here's a quick and easy rundown of what we're expecting in the markets and economy for 2026 and what it means for your financial plan. Let's start with the economy. We expect a modest slowdown early in the year, followed by a rebound later in 2026. Even with that soft patch, the economy remains supported by strong AI-driven investment and government spending, which helps keep recession risks low. A cooling labor market and softer consumer demand should continue easing inflation, and we anticipate the Federal Reserve will begin gradually cutting interest rates throughout the year. Now, on to stocks. The current bull market still looks healthy as we head into 2026, powered by ongoing enthusiasm around AI and a friendlier Fed. That said, valuations are elevated, so gains may be more modest and volatility may pick up. Very normal for this stage of the cycle. Our fair value target for the S&P 500 is 7,300 to 7,400, suggesting more room for growth. The strategy here, stick with your allocation and be patient, using market pullbacks to selectively add equity exposure. Let's talk bonds and cash. For the first time in years, bonds look compelling, thanks to yields that remain attractive relative to history. We expect 10-year Treasury yields to stay in the 3.75% to 4.25% range, making income, not big price moves, the primary opportunity. As the Fed cuts rates, returns on cash will drift lower, making high-quality intermediate-term bonds a better long-term fit for many investors. On the currency front, the U.S. dollar remains in a long-term uptrend, supported by tech leadership, fiscal stimulus, and global demand for yield. However, upcoming rate cuts and ongoing trade and budget uncertainty may limit further upside. Think stable to slightly strong, but not breaking out dramatically. Now a quick word on commodities. We remain constructive on the asset class, even with the uncertainty surrounding global trade and shifting monetary policy. Precious metals continue to stand out, supported by many of the same forces that drove strong performance in 2025. And with the administration prioritizing supply chains for critical minerals, the broader metals space, especially domestic producers, could see continued support. Finally, alternative investments. Given today's market environment, we continue to favor strategies that diversify portfolios and reduce downside risk. That includes equity market neutral, discretionary macro, merger arbitrage, and select private market opportunities like private equity, infrastructure, and secondaries, all areas that have shown resilience and improving momentum.